Well, hello. We are here for our Rational Radio. You can see I'm back home again. Dave, I've been in WeWork, but it looks like the way things are going at the moment with the COVID-19 massive spike in infections, it's probably best now just to stay at home and try not to be part of the problem.
I'm at home in my slippers, tracksuit bottoms, quite comfortable. Only time I go out is early in the morning, 6 o'clock, nobody's on the road. Strangely enough, a lot of people are on the road, but I agree, you don't have to take any risks, and particularly as we get into my age group, a lot of warnings about it, so very careful about it.
But David, you're not diabetic.
No,
you're not diabetic.
No.
And you're certainly not obese. So you got to be, yeah. You might be a little older than 50, but I'd put my money on you.
I think, but what's quite interesting is you suddenly realize I had to take my car in for a service this morning. My glasses broke, so I need new prescription. It's mainly I had. I had the option. What do you call it? Linda, help me. Cataracts. I had cataracts 5 years ago, and I like to have them checked. And so you've got to do those things. You can't stay away from them. So, but you take precautions. You just got to be careful when you're out there.
Well, we got lots of people on joining us today. We're going to try and opens a few microphones, David, so we can have some conversations. We've got also people that you know well, Adrian Saville, Brett Duncan, Ricco Friedrich. They'll be joining us in the hour and starting off in 15 minutes time. But let's just make sure that everybody can hear us loud and clearly. And our general manager, Stuart Lohman, is, as always, controlling things. Stu?
Excellent, thanks, Alec, and welcome, Dave, as always. Just quickly, those new to the webinar, there's a little high five button. If you can see Alec and David and hear my voice and now see the presentation underneath those two cameras, excellent. We've got some high fives coming through, Alec. That's always good. No complaints of soft noise yet either, which is a good thing, but let us know. And then obviously Alec mentioned he's going to try something new with the cameras, but we still have the old question and answer process. There's little questions drop down menu on the right hand control panel. If you put your questions in there as well, Alec can pick them up and pass them on to the relevant panelists at the time. But Alec, all good from my side. Good luck.
Thanks, Stu. And I'm hoping, guys, that once you pose your question, if you would like us to open your microphone, just say, I'd like to speak to you, and we'll then do our best to open the mic. We'll try and find you, because we have restricted it only to Biznews Premium to try and restrict the numbers. We're at 126, I see, at the moment, David. So we'll have to run through there somehow and perhaps find the person who's posing the question, and then let's have that chat. Anyway, Mr. Shapiro, don't you like the picture this week?
Yeah, that was 2 years ago. It was at my granddaughter's bat mitzvah. Yeah. I haven't aged at all. Linda has aged a bit, but I haven't.
And your hair hasn't grown either, Dave. So I think we certainly are privileged to have you here with us today in person, as always. I need you to take us through your story in the Sunday Times this week, and I'll tell you why. We've got Brett Duncan who's listening in, and he'll be talking in a little while, because Standard Bank Online Share Trading is the oldest and the biggest of the online stockbrokers. And you were talking about Sasol's share price being moved up by day traders in the United States, perhaps.
It's an intriguing story. Simply that, we follow local analysts, and we follow analysts that track Sasol. And yes, when the share hit 20 Rand or 21 Rand, it was perhaps a ridiculous price. There were still a lot of vulnerabilities surrounding the company at that stage. And yes, they moved up pretty quickly as the oil price recovered to 70, 80 Rand, where we felt that, according to analysts, was a reasonable price for it to settle until things changed. And then all of a sudden, within a 10-day period, from 70 Rand, they went to 170 Rand on massive volume, on huge, huge volumes, which I couldn't identify. And I started asking questions because, Alec, the background is that if an institution, and Adrian's on, Brett knows, all people who are familiar with the market here know that if an institution buys over a certain amount, you have to make some disclosures. And the amounts that I tallied up came to about 12 to 15% of the issued shares of the company. So there was a huge, something like 75 million shares that traded. I was talking to Nick Kunzer of Sanlam, and Nick said, go to the ADR that's trading in New York. ADR just is like a proxy. I'm not going to go into describing what an ADR is, but for all intents and purposes, it trades in America like as if it had a secondary listing over there. And I found that massive amounts of volumes had gone through America as well. And the number of shareholders in the ADR had gone from 270 to 31,000 within a 10-day period, or within a very short period, put it that way. And of course, this led us to believe that this was all part of the Robinhood online broking fraternity, which had attracted a lot of new participants, and they were going for all kinds of energy shares that had been bombed out. Not only energy shares, that any share that had been bombed out. So, the conclusion was, if you want to see where the trade had taken place and who's been participating, it seemed to be in New York rather than here. Although I must say that there were a lot of participants as well, and Brett might be able to give us some detail around that as well, because I know that Charles Savage has said that the turnover in Sasol has also been extremely not volatile, but very vibrant. So that was the story.
Well, we're gonna talk to Brett about that story a little bit later, David. But just repeat those numbers again, because they really are quite spectacular. 30,000 day traders, is that right? Did I hear you correctly there?
Well, to be exact, 31,000 participants. In other words, that's like your shareholder base going from 270 in America to 31,000 in the ADR. I don't even know how many shareholders there are locally in Sasol. I doubt whether it comes to anything close to that, unless there may be individuals, but I'm not sure that the JSE has got 31,000 private clients. But it gives you an idea of the level of activity that we saw in a market that has been pretty dormant. There were shareholders, there was activity in that. ADR.
So, Dave, are you then telling us in our portfolio, Adrian, could you mute yourself, please? Thanks. If you know in our Biznews portfolio, we bought these shares of Sasol at 28 Rand. Are you saying to us that they've been artificially inflated by day traders in America? And watch out, because that 140 Rand that it's trading at the moment may not last for very long.
That's an open question. That's difficulty. That's a difficult question, because what's happening now? They came out with a set of results recently. They still have huge debt, around about 170 billion debt. If they can overcome that debt by selling off some of their Louisiana project, some of the operations there, raise enough money. At the moment, the danger is that they're therefore at the mercy of the bondholders, the people who have lent them the money, who have been a little generous in what we call covenants. In other words, have undone those covenants. Normally, anybody who lends you money wants to make sure that you're going to pay back, and therefore keeps a watchful eye on how you operate the company. In other words, they look at your profits, that you're not wasting money or going in other directions. So they do have control. And if you break these covenants, if you break these rules, they can demand the money back. So they've been pretty generous in allowing them to get back on their feet. But we still need to see debt come down by about 30-odd billion. Now, if they can get over that, if they can overcome these short-term issues, then there's a good chance that they could be worth 150, 160 Rand. So that's the other side of it. But I was only addressing the speed at which the shares rocketed from 70 to 170, 180 or something, and they've come back to perhaps more acceptable levels at around about 140. But a lot depends on operational issues now.
Have a look at your screen now, Dave. And it actually talks to your point. This is from the Wall Street Journal. Obviously, all Biznews Premium subscribers do have access to these charts, this data. And if you see it, it really makes your point. I'm going along at the bottom for the volumes, and the volumes are, as you can see, almost non-existent. And then comes the week of the 8th of March, and the volumes start rising and rising and rising. But in those previous 2 weeks, when it went up so strongly in US dollar terms, the volumes have gone through the roof relative to the past. Let's just get rid of that simple a moving average. So the volume numbers down the bottom there are very, very clearly supporting the fact that, gee, Dave, I mean, look at that volume on. All right, let's try and get it down to a much smaller period over the last 3 months. And even smaller than that in the last months. You can see that the volumes that have been going through in the United States have been very, very significant in these ADRs. 12 million, 10 million, 9 million, 9 million. And that, from your analysis, is around 30,000 Sasol shareholders in the ADRs.
And they would be trading through Robinhood, Interactive Brokers, TD Ameritrade, Charles Schwab, and all the other platforms that exist. You can see the price differences there. You can see how, as those volumes increase, they spike. Now, we do pick them up from our market because, without going into too many technicalities, the trade that takes place in the ADRs has to be satisfied in real shares that come from South Africa. So those trades find their way back into our market as well, as we satisfy the need for the issuer of the ADR to find the scrip. In other words, to back what he sold on or what has been traded with real scrip that's moved across into that ADR account. So we saw the trade on our market, and Sasol has been, together with Nice Person Process, which are always up there, a very, very big trader in our market recently.
Now, this is the 1-year chart of Sasol on the JSE. And my goodness, does that not support your thesis? If you have a look there from mid-March, those huge volumes relative, and Sasol's a big trader anyway on the JSE, but those huge volumes relative to the past had to have come from somewhere. And what you're saying is they came from day traders in the United States.
Yeah.
And hence you see that huge improvement in the share price over that period. Well, okay, so the $1 million question, or maybe the $1 million Rand question, is those of us who've had a lovely ride on Sasol in our portfolio from 28 Rand, do we now sell and bank the profits? If you don't get a 5-bagger in a couple of months that often.
Well, you can see that it's pushed up by traders, and that always leaves you vulnerable for them to square their positions, get out of their positions. You've got to hope that more and more traders come in. I can't give from my point of view, we're just making you aware of the background and say, okay, this is not some Vanguard coming in, or a Sanlam or a Mutual or a Allen Gray of that nature, who tend to be longer term holders, but rather people of a short term duration. And you know how vulnerable they can be, and you don't know how geared they are. That's the other thing. So just I'm just saying be careful. This doesn't mean that the share price is going to fall in a heap, by no means. You could find proper buyers coming in. When I say proper, longer term buyers coming in and perhaps sapping up the shares as they ease back.
Well, let's bring Adrian Saville in now. He's our next panelist. He's here. Adrian, hopefully we can get you on screen. I have sent you a webcam request. And just to remind you, as Stuart did say earlier, there you are. As Stuart said earlier, if you would like to pose a question, you can write the questions in the little box. It's got a little question mark on in front of you, or we're going to try and open up your microphone to pose the question in person. Just let us know if you'd like to do that. Adrian, look, you look a little cold. Are you in the wrong part of Joburg?
Yeah, well, look, we at least we know my microphone is working. I apologize. I thought I was on mute. This shows you just how unforecastable the world is. If you told me one day you will be sitting in a thermal jacket in your back room at home speaking to Alec Hogg, it was not like a very Dodge forecast, but here we are.
But it is the middle of winter today. That, in fact, it is our exact middle of winter, supposedly on the 22nd of. You're allowed. I've just got the good fortune of having a room that's got sun streaming in. And is nice and warm. But Adrian, maybe to pick up on the conversation Dave and I were having just a moment ago on Sasol, because many South Africans have been trading the stock or investing in the stock. When we saw it go down into the 20s in our portfolio, although the longer term view on Sasol has to be looked at with some caution, at 28 Rand, it just seemed ridiculously cheap, and we put it into our portfolio. But as David says, and those graphs clearly showed, the action which has taken it perhaps beyond a natural level of 80 Rand to the current 150 Rand has been pushed along by day traders. Would you subscribe to that thesis?
Yeah, Alec, if you look at some other milestones or action stones along that timeline, what you'll see is the kick up in ADR activity corresponds with share price spikes. So there's, I would be perhaps endorsing in an even more vigorous way, saying there's a strong correspondence, not just in the recent past, but if you reach back further, you'll see each of those Manhattan peaks tends to correspond with a kick up in the share price. Now, when it comes to the recent events around Sasol, maybe to put another point behind David's observation is if it is these ADR participants that are picking up shares, one thing that you can probably be reasonably assured of, alongside the fact that they are very short-term participants, they're trading this, they're not investing, is they're not going to be particularly active or interested in the governance or capital allocation or capital stewardship in the business. They're there for the ride, and it's being treated as a game rather than a careful allocation of capital. And if it doesn't work out, they'll move on to the next opportunity. So I would not take this as a sign of confidence in Sasol. In fact, I would put the opposite observation. I would put it as a reasonable concern in a company that has battled with capital allocation.
Well, I guess then we have to have a look at some of the other favorites, and Tesla would doubtless be one of them. You would think. I remember that was in our portfolio at one stage. We got out in the 300s, and of course it's now above 1,000. Is this also a day trader's delight?
Look, Alec, I'm pleased to know that I'm not the only person who thought it was expensive at 300. And if it was rich at 300, it's extraordinarily full at 1,000. You just can't get to that valuation. The only way that you can get to that valuation is by Excel working out perfectly, by Tesla being able to grab a whole bunch of market share, no production problems, no regulatory problems, and it's very hard to see that materializing in an industry that's moving faster than any of the individual participants. So as much as I think Tesla is an extraordinary business with the most remarkable individual behind it, the share price and the business are always different things.
Well, there's a 6-month graph now where it was $400 up to $1,000 a month. It's been an incredible, well, I suppose if it's funny, you go back to that mid-March period where Sasol started running, and it's a very similar situation here. Round about the middle of March, it was under $400.
Well, I mean, this plays into the story that the online have moved from sports events to stock events, and that this is the participation that's happening. I mean, if that is, then we need to bring another order of thinking to the companies that we're looking at. And to go back to your and David's earlier conversation about Sasol, imagine a world in which these day traders hadn't stepped in, and the Sasol share price then doesn't get this big kicker. So if that is the case, if it's those day traders that have caused the kicker, then absent those day traders, the Sasol share price stays very, very depressed. And now I think the conversation about capitalizing the business and covenants is an entirely different one.
Adrian, what would you be saying to your students at GIBS? I know you're a professor at GIBS as well, but what would your students be if they were posing the question of Sasol to you? What would your response be today?
Sure. Okay. Well, of Sasol, I made the observation a few moments back that it's not a business that has showered itself in glory in terms of capital allocation, and hindsight is always an exact science. So let me qualify that for a long time, we've expressed concerns about their ventures into the United States, the Lake Charles venture. They've gone a long way from home in a highly competed and highly regulated market. They've stretched the balance sheet, and they've done this in a commodity market. So it's not the type of industry where you can be relatively sure of your revenue streams unless you hedge and protect your revenue with derivatives, forward sales or futures agreements. And they didn't do any of that. They left themselves naked to a very, very volatile commodity price, the raw materials and the oil price. And they've done this in a market a long way from home, highly competed, highly regulated environment in which they're a small participant. So I mean, the risk just didn't make sense to us. And when you got down into double-digit numbers for the Sasol share price, you mentioned earlier the 20, 30 Rand territory. It was very hard to see how, in that environment, they were going to get the elevated prices they needed if they were forced into a fire sale to dispose of some of the Lake Charles assets or any other assets. Hard to see how they would rescue the balance sheet. So this is a business that it just looks like it's had a sequence of really bad decisions and some unfortunate events. They come together and they produce a company that I wouldn't be buying the share at this level or even lower. I wouldn't be buying it here. There's just too much risk in the arrangement. They need to convince me that they've fixed up their risk management, their systems, their capital allocation. They need to convince me that they've done that.
Well, thanks. It's very timeless because we've got our portfolio tomorrow, our update of our portfolio. And as we've had an incredible ride already, we're not really, the portfolio is a long-term one. It's a bit like your investment style, Adrian, very value, very long-term based. But if you've had this extraordinary increase, thanks to a fortuitous event, which is the day trading factors in the United States, well, maybe you should be taking profits on this. For some reason, I can't see the questions. I'm sure you can, though.
Hi, Alec. Sorry, there aren't any questions coming through, so we need to prod the audience a bit here, I think. I'm not
Oh, my word.
nothing,
Usually there are far too many questions, but I think perhaps the conversation is stimulating enough not to have it interrupted by and people a bit scared to maybe open their microphones. Adrian, just from a broader perspective, leaving Sasol aside, we're going to be talking small caps with Ricco Friedrich a little later in the national radio. But how are you seeing the stock market in South Africa at the moment? Some of our commentators believe it's like a dripping roast. What is your take when you bring everything together?
Probably going to be unhelpful if I tell you it's both. On the one hand, there's parts of this market that have just run way too hard. They defy logic. They don't correspond with economic reality. And I think that is led by global influence. If you look at the shape of the market recovery, it's unquestionably V. You've had the fiscal hose and the monetary flamethrower hurled into the equation. The type of policy response is multiples of what we saw in the global financial crisis. The global financial crisis, it took markets a little while to get back to find their feet. But when you look at the fiscal stimulus and the monetary stimulus that have happened across markets, there's a couple of standout features. The one is the stimuli are multiples of global financial crisis, and not 1 or 2 times financial crisis. We're talking 5 and 10 times the financial crisis stimulus. The second is it's coordinated in that it is monetary and fiscal policy that are working together. So you've got this double-handed stimulus. And then it is coordinated by country. Everyone's in this together. Japan, Germany, United States has joined. So it's almost unsurprising then that markets have responded with this type of vigor. The fact that the Fed is buying corporate debt, sub-investment grade corporate debt, actually beggars belief. But that's where we are. And to me, that's one way of making sense of the way in which markets have recovered. But economies are nowhere near the shape that markets are in. Economies, if you look at the mobility data, if you look at the transactions data that's made available, in various live data sets, air traffic data, there is no way that the economy is remotely close to back to the activity it was. And even if you've got that level of activity, you don't have the level of spend corresponding with that activity. If your home is anything like my home, when we're venturing out, we're not venturing out with the same appetite and vigor. The world is much more cautious in this environment. And the Chinese data supports my sort of anecdotal observation. The Chinese data shows us that this is a long stretch of recovery rather than a sharp bounce back. And so those numbers still have to come through the system. We've got to have them reported in financials. My suspicion, our suspicion, from an investment perspective, is we think that this market is very vulnerable to a down leg, and that will be globally led. In the same breath, there are some assets that have been sold down and left down. And those make for really interesting reading, especially where they might be second line stocks off the main beat. And there's some examples that might jump out would be the likes of Altron, I think is a really good case in point. Beautiful global footprint. It's unbundling. It's by its technology business in the UK. It's got a lovely anchor tenant in its vehicle tracking business. And the share price got pushed down in the sell-off, and it's recovered somewhat, but nothing like the market. So yeah, that's that's a good economics two-handed answer. On the one hand, be very, very careful. On the other hand, look closely.
Adrian, good to be talking with you, and all the very best for you in your new endeavors at Bidvest Financial Services. I know it's not that new. You've been going at it for a couple of years already, but it's really good to have you on the program, and look forward to the next time. Thank you, Adrian.
Thank you.
David, as Adrian departs us, your thoughts on what he had to say about the market generally before we let him go?
Well, I can't argue with him on both assessments, the economic assessment and then the market assessment. The problem is if you go and do your research, you find that markets, I think for the last 30, 40 odd years, never track what's happening in the economy. They're two live animals, on different paths. And that makes it very difficult for us as portfolio managers to try and understand where to put the money. I think that markets are forward-looking, and what the markets are doing is, and Adrian knows, if I'm not going to lecture a professor, but the intrinsic value of a company is really the present value of all future cash flows, or whether it's dividend or earnings. And the problem is, what discount rate do you use? How do you bring it back to a price when there's discount rate is zero? At what price do you value a company? So it's a challenge, and you know that I'm very tech orientated, and I'm saying, okay, we're going into a tech economy, we're going into a data economy. Who are going to be the disruptors? Who's going to be the disrupted? And I'm sticking to the disruptors and saying, okay, I'm going out 4 or 5 years hence to see whether these businesses can survive. But I think it's a big challenge for anybody who's managing money.
Question here from Shaman Prem, who says, it's just a comment rather, to say the reason why Sasol got into trouble was because it had North American chief executives, David Constable and Steve Connell. Not fair. Americans are not all, well, many of them are extremely good business scientists. So will America ever be able to square their massive deficits? Can they keep borrowing whenever they feel like it? That's from Len Giovanni. Perhaps we could ask that question of you, Adrian, before you go. Massive deficits. You spoke about the fire hose of money that's being thrown in.
So US fiscus have the advantage that they own the world's default currency, and as long as they look after that default currency, as long as they don't print it Venezuelan style, then they've almost got a license to keep pushing that capital into circulation. And what the US dollar has in addition is that if they do overcook the domestic economy, there's a natural escape valve into global capital markets. So they've got a very valuable cocktail of access to world markets, global capital appetite, the currency of ultimate reserve, and they should jealously guard that. As long as they have that, then yeah, they could print this responsibly, and they could support these debt levels. As David points out, at zero interest rates, you can support a hell of a lot of debt for a long time. You can also do some wonderful present discount valuations.
Extraordinary. Anyway, Adrian, thanks again for your contribution today. As you can see, Brett Duncan has come onto the screen, or did come onto the screen. Brett, you're back now. There we go. I'm going to bring up that Sasol graph again, because you guys, you're very close to the action at Standard Bank online share trading. You would see what the retail investors are doing. And has the run been in Sasol been a result of what's flowing through from the United States, or are South African investors also getting in on the action?
So we've certainly seen a huge uptick in the retail activity. If I look at the number of investors on our books who are holding Sasol, it's more than doubled over the last 3 months. going into sort of February, March, let's say that on any given day, Sasol has always been quite a popular trading stock. Could be 5% of the day's trade from the retail investors. I've seen it spike to as high as 30%, and sort of sitting on current levels around 15% odd. Look, Alec, it's not being driven by domestic day traders. I don't think there's enough of them, but I take a lot from the fact that we have seen a huge uptick of interest in the ADRs in the States. I mean, when the stock goes from $1.25 to $8, that's kind of brings in all of the punters, South African or not. So I think there is a lot to be said for what Dave was saying, is that it could be driven by that. If I look at the volumes on the ADRs, it's probably about half of what's going through on the SA market. So it's certainly very, very significant. So yes, there's a lot of interest in Sasol. We've seen a lot more activity. We're doing over 1,000 trades a day from the domestic side. I've looked on our offshore trading platform. The numbers are still quite small in terms of actual trading of the ADR. But in terms of the movements in the stock, I think there's no doubt that there's a lot of speculative activity that's coming in there. And the fact that everyone's kind of scratching their head and saying, where is it coming from, suggests to me that a lot of it could be driven by, day traders in the US.
Well, there's a graph that really shows the ADR very, very well indeed. Just take that moving average out there. When we go back 3 months, it's the 3 month graph, again from the Wall Street Journal, $1.34. And as you say, in 3 months, gone to $8.10. So it's been a wonderful honeypot for the day traders. But I guess the question to David's point, when they lose interest, does it go back to $1.34?
Well, that's the $1 million question. I mean, I know in your world that you speak a lot about price earnings valuations, and if a stock's got a PE of up near 100, then one should be cautious. And Sasol would be pushing up on that in terms of where its current earnings are going to be. So you need to look forward and look through this year, and then the forward PEs are much more attractive. But in terms of derivative players, we look at volatility, and Sasol's sitting on an historic volatility of 200% at the moment, and that is massive. So I think it's a great stock, but I think that if you're in it for the short term, it's going to be a bumpy ride. So one thing I can tell you, it's unlikely just to sit where it is. So it's either going up or down, and you've just got to be very, very cautious. Once you're playing in this space on a stock that's gone up 6-fold, with potential for some corporate activity, with a very volatile rand, with a very volatile oil price. I mean, it's like a trifecta, the perfect storm, one could almost say. So it's not for the faint of heart, that's for sure.
Okay, so we are going to be having our webinar tomorrow for the web trader clients. We've had an unbelievable run on our portfolio, helped by Sasol buying in at 28 Rand, and now it's 150. If when we bought at 28, you'd said to me it was going to double, I would have thought that was a little bit outlandish. If you'd said to me it's gone up, it would go up 5-fold, clearly the view would be, well, that's crazy. So I guess what you've said, what Adrian said, what David said, at these levels of 150, we should be taking our profits, although it's not what we do in this portfolio. But when things just go ridiculous, surely you should reassess.
Yeah, so I think that there is a middle road. I think that very much in your Warren Buffett methodology, you'd be holding on to it forever. And the fact that you bought it at 25 Rand, it's moved up significantly. In fact, if you believed in the valuation, you might buy more now, right? I mean, you always add to potentially a winning position. But the long and the short of it, when it's moved this quickly, you're in a very fortunate situation that you don't need to be all in or all out. You could quite comfortably take profits on a small section of your initial investment, basically bank that, right? Gives you limited downside risk, and then keep a portion for if the stock goes up. I mean, let's be honest, Sasol has been as high as 550 Rand. So it's still a long way off its previous highs. But certainly in the short term, from a trading point of view, if it's a trading position, one would be looking to lighten. From an investment point of view, one would be very, very conscious of the fact that it's had a very significant run, and it's likely to see some form of consolidation. It's very unlikely that it can just keep going up in a straight line.
Brett, how are retail investors reacting at the moment, given that there's all kinds of new pressures due to COVID-19, due to the lockdown, due to companies going bankrupt? How are you seeing the reaction from your client base?
So you need to, break it up into the different components. I think for the long-term buy and hold type investors, a lot of them have kind of just taken to the sidelines and haven't done too much through this. And to be honest, with the V-shaped correction that we've seen, they're pretty much back where they started at the beginning of the year. So, volatility is only important in the short term. Over the long term, it becomes irrelevant. So for them, there's just been a lot of noise, but their portfolios are pretty much back where they are, and they're sitting on their hands, a lot of those guys. From the day traders' point of view, we've seen a massive upsurge in interest there. I think a lot of people sitting at home with a little bit of extra time on their hands have taken to a bit of speculating. I think also with the massive moves that we've seen, obviously there's lots of headlines, lots of interest. So, there's a lot of, we've seen a large uptake in new accounts coming in, people having taking on speculative positions. I think on the whole, there's a lot more interest, but people are cautious, because at the end of the day, I don't think any of us expected the market to do quite what it's done. I was very much out of the camp looking for a V-shaped correction. I'd always thought there was going to be some form of W in the story. I just didn't think it was going to be a capital W, which is what it might end up being. But I think at the end of the day, we're just talking about a crazy market that none of us have really seen. I mean, one has to go back to sort of like the 2009 period to even have anything that's vaguely similar. But even this feels more hectic. I mean, it's become, on average, you see stocks moving 10, 15% in a day. I mean, that's just incredibly volatile. So I think there's a lot more interest, but also a lot of caution. And I think I would also say to a lot of people that are coming into the market and potentially on the webinars, now is not the time to be silly in these markets. They've come off a low base, but they've run exceptionally hard, and one needs to have a good look at what's happening out there, because as you say, if Sasol is being driven purely by speculative demand, as quickly as it's gone up to 140, it can certainly go back to 70 Rand. Let's hope that it doesn't go back down as low as 20 Rand, but it is unprecedented, the movements that we're seeing.
David Shapiro, would you come in here? Because there's a couple of other questions that both you on Sasol, it seems like it's almost a Sasol show today, that are being asked. The one from Agash Pillay, who says that surely bringing in a equity partner in Lake Charles is very positive for Sasol. Yes?
One doesn't know what they're going to do there. If you listen to Adrian very carefully, he summed up the position that Sasol is in at the moment, in a very precarious position. He calls it bad capital allocation, meaning, listen, we put 250 into a plant that's worth a tenth of that at the moment. Things have really gone wrong there. This is a company that had a market cap of 500 billion, taking into consideration how much they paid for Lake Charles, and now they find their market cap is down at 88 billion. So you can see the damage that has been done even at these levels. Alec, the worry, so the big worry with Lake Charles is that they need to sell off portions of it, and they've got to realize some big losses when they do sell off those portions. And also, when you sell off a portion, they're not looking for partners. They're probably going to sell off certain plants. And when they do that, they're also giving up the income that they would have earned on that. So, that's their danger. They're trying to get the debt down, and then they've now called it Sasol 2.0. In other words, they're forming a new chemical and energy business, and probably almost the same as BHP Billiton did, when they floated off South 32 and saying, listen, we're going to focus on, this is going to be where we are. Down the line, we'll probably get rid of the other businesses, or just allow them to kind of run themselves down. Very similar attitude to what we saw in BHP. But it's a precarious position. And what intrigues me, Alec, is that how difficult companies like this love to attract speculators. Everybody, why do you have to look for trouble? You know, I always remember being with you with Charlie and Warren Buffett, and they said, no, this goes into the too hard file. You know, in other words, too hard to understand. You know, leave it alone. And yet, there's almost this compulsion. People love to get involved in businesses, believing that they are going to turn around. It's if you look very carefully at the fundamentals, the company's still got a lot to go through in that. So if you can afford to take the risk, by all means take it. But for those, why look for trouble? Just find something else. As Adrian said, there's Eltron. Go have a look at Eltron.
At 28 Rand, it was a no-brainer. At 150 Rand, it's too hard to work out. And I think that's the way you've encapsulated. There is another question on Sasol from Doe Pinar. He wants to know, do you know if there's truth in the rumor that Sasol will be offloading its fuel and retail convenience business to government's fuel business? I think there was quite a lot of strong speculation about this. In other words, the Sasol service stations. Dave, was there any substance to those discussions?
We don't know. These are all rumors, and probably they're thinking about everything. I don't think anything is off the table. So I wouldn't dismiss it, but on the other hand, it hasn't been substantiated. I'm sure they're meeting on a daily basis trying to work out how to reposition. At the moment, the big issue is they're going to need about another 40 billion Rand. They need to sell off assets to realize it, to put them in a more comfortable position, which will satisfy the bondholders. Bondholders meaning the people who have lent them the money. So I think that's their priority. How are we going to get that money? And I think they want to avoid a rights issue if they can.
Well, it's much easier to avoid a rights issue now than it was at 28 Rand. And that's also, people sometimes don't quite understand that a rights issue is the issuing of more shares. And the last time you want to do a rights issue is when you actually have a low share price. The time to do a rights issue is when you have a high share price. So it's more likely if they can. It'd be interesting if they went to the market, Dave, and had a rights issue now and asked shareholders to put in money at 150 Rand a share, how much support they'd get. I've just put this on screen because Peter Bodel wanted to ask about a little bit of insight on the future of Tencent, which is up on screen there, hence Prosus and Naspers. Tencent's, I don't know if it's day traders who are doing this to Tencent as well. They could be having a lot of fun in Hong Kong's market too, but it's been a phenomenal performance since mid-March.
You've got to do your reading on Tencent. I mean, it is a remarkable company. There are a lot of investors, the more serious investors, and serious, I mean, those who like to look, dig and delve into valuations, believe that it's the most expensive it's ever been. But I think it's worth going into because they're so well placed for the Chinese market, and it's not an easy company to understand because it has so many tentacles. And the Chinese market is massive. I mean, you've got 1.3 billion people there, many of them who are a lot smarter than we are and a lot more tech savvy than we are. But you just have to look at the gaming side of their business to understand what a powerful organization this is. And I don't even think they've tapped the resources that they can get into. They're not heavily into the advertising side of it. Most of it is subscription-based or fee-based type earnings, but it's a remarkable business, and that's why if you're a Naspers, Prosus shareholder, or even Tencent, just go for the ride. There's going to be bumps along the way. That's the nature of the market, but very, very impressive business.
Well, there's a Naspers share price as well, and we certainly will be going for the ride there, not taking profits, as seems to be the advice on Sasol. Ricco Friedrich is with us now. Ricco, I can see that your mic is unmuted, so hopefully you can hear us. Not sure if we can get you on screen.
If you can hear you fine, Alec.
your camera, any luck there? Not the end of the world if we can't get your camera on.
Okay,
but
wait, it's there you go.
we should see you in a moment. There we go. Hi, Ricco. Good stuff. Well, nice to see you again after all this time. We asked you to come on to really just unpack a little the note that you sent out to investors in this past week, and I'm going to call it up in a moment. My apologies. We seem to be. It's nothing wrong with anything. There we go. There's a nice picture of you. You look pretty suave in that picture, Ricco.
Yeah,
but
I look a little different there. Right? It's what
well,
lockdown does to you.
It's what lockdown does to you. Yeah, I can't wait to get to a barber or a hairdresser or somebody in the near future as well. But in your note, you actually had 4 graphs that I'd like to really pick up with you on. And maybe we can start with this one. Essentially,
sorry, Alec, can you hear me?
We can hear you perfectly, not to worry. Really just people who don't know you, you're Corky Koyman's colleague and Sean van Kyke's colleague at Denker Capital. Denker was born out of the old Sanlam asset management, and you're really a small cap expert. And it was interesting. I loved this graph because you took it all the way back to June 1995 and said or showed us that small caps actually perform, although at times they might go up and underperform or overperform the market, but generally speaking, they are in line with the market generally. Is that what you were wanting to, the point that you were wanting to make with this graph? Ricco? Stu?
Alec, I'm not sure when he put his headphones on, Ricco, if it's changed the mic setting. Because
okay, can you hear me now?
Perfect.
Oh, we got you. Yeah.
Okay,
Yeah.
sorry about that.
No worries.
No problem. So the key message actually is that during periods of financial crises, and this is probably the 3rd biggest market event that I've experienced in my 20 years or so, you tend to see the small cap stocks take a major beating, and this crisis has been no different. So, you know, if you look back to 1998, you look back to 2008, and now, small caps tend to underperform quite significantly when you enter the sort of risk-off type of environment. I guess, you know, what we have to acknowledge is, given this peculiar circumstances that South Africa has been in for the last few years, it's been pretty tough for SA Inc. businesses anyway, in an environment where GDP growth has been lackluster at best. So even before this sort of sell-off, you can see from around about 2017, we have seen small caps underperforming. And in fact, over the last 3 years, in absolute terms, small caps are down about 45%. So they've lost just about half their value in the last 3 years or so. But what is interesting, Alec, is that this is very similar to what we see in the United States and the UK as well. In times of crises, you have this flight to safety, and small caps tend to underperform. However, this is when you see, you know, some of the best buying opportunities. And I mean, in my 20 years in the market, this is the 3rd best sort of buying opportunity in terms of mispricings of some of these small caps. And I say that with caution because, you know, small caps are not really this homogeneous group of companies. They are quite different, and one's got to certainly do your homework and identify those businesses that you think will survive. Because generally, you know, there's a lot of companies certainly that I've seen in the last 20 years in the small cap space that tend to disappear. And as you highlight in this chart, I mean, one of the key reasons that a lot of these companies don't make it is their balance sheets in particular. So either overly geared, they've done expensive acquisitions, they've borrowed money to do these transactions, and they haven't worked. And eventually, you know, they'll end up having to impair or write off a lot of these deals, but they're still left with a debt on the balance sheet. So one has to be quite cautious in your approach. But certainly in my 20 plus years in the market, we're seeing some of the best opportunities that I've ever seen.
This is so interesting. So
yeah,
in other words, Ricco, and what we're seeing here is that there are small caps that they're very toxic. You need to stay away from them, but that's because their net debt is going to be outrageously high. However, there are other small caps that are not in this category, in this average category, and they've been treated by investors the same as the bad ones.
That's absolutely right, Alec. I mean, we would sort of divide the universe of opportunities in the small cap space into three. The first one are essentially these cheap, bombed out businesses that probably, I mean, before the crisis hit, were already under significant pressure. They either had challenged business models, weak balance sheets, poor management, or a combination of the above. And I mean, there's a long list of these, the likes of the Blue Label, EOH, Tongaat, and Nampak, Pumalele, Adcorp, Come. I mean, I could go on for a while. These are, and as was referred to earlier by David, you know, these are probably businesses that we would be quite happy just to put in the too hard pile. The odds are generally stacked against you. Yes, there may be one or two opportunities that could go up 5 or maybe 10-fold, but by far the bulk of them will probably not make it. You know, if I go back and have a look to my days, sort of 2004, when I was running a small cap fund for one of the large life insurers, I had a look quickly at the top 10 holdings we had in the fund back then. Most of them aren't even around today. So one's got to be quite astute with respect to this first basket, and probably best avoided. The second basket is sort of your holding companies. And I think, you know, their business models have also been quite challenged, trading at big discounts to their sum of the parts value, with lots of question marks around the value that's being added at the holdco level. But I think there are definitely some very interesting opportunities there, and some of these holdcos are perhaps looking at restructuring and unlocking some of that value. We're seeing that with the likes of a Grand Parade, for example, and there are a couple of others. And then the third basket, which you referred to, are those businesses, good businesses, that have been caught in the broad sell-off as well. And these are the ones that interest us the most. And if I can give you, you know, some examples of like a CMH, Italtile, Hudeco, Oceana, all great businesses. They've been around for 30, 40 years, in some cases longer. They've been through many down cycles in the past, perhaps in many instances with the same management team, so they understand the importance of managing balance sheet and cash flows. And, you know, if you look at, for example, a CMH right now, I think they're reporting results tomorrow. I mean, the results are going to be okay. The next 12 months are going to be really, really tough. I mean, I wouldn't be surprised if they report losses, in fact. But 1 year's worth of cash flows makes up maybe 10 or 12% of the intrinsic value of a business. You're getting to buy this company at net asset value. That's only happened 3 times in the last 25 years. So, and this is a business that's compounded its NAV growth at 11% per annum. It generates a 30% ROE and returns an enormous amount of cash to shareholders. So, you know, this is one example of some really fantastic opportunities that we're seeing out there in the market.
The graph we've got on now, the price to book ratio of the small cap index, it's only been, in fact, it's never been at this level. It looks a little bit like the business confidence index at 5 points out of 100, which has never been in single until now. So it really would be spurring us into trying to find cheap assets.
Absolutely. Look, we do use this ratio as a sort of illustration of relative pricing over time. You know, a lot of these small companies, as I alluded to earlier, that have done expensive acquisitions that haven't worked out, are now having to impair a lot of the goodwill and the intangibles that they bought. And so, you know, with the market being a bit of being forward-looking, it's anticipating some of these impairments in this book value. But there's no doubt, I mean, you know, the basket of small cap stocks that we've selected is trading pretty much at close to book value and generating 16 to 17% ROEs. And that's phenomenal opportunity. So we wouldn't necessarily just simply go and buy the ones that are trading on the lowest price to book. I think in many instances, those are businesses that are probably going through a very difficult time and may not make it. So you've got to interrogate, you know, the quality of the balance sheet, the cash flows. And we don't know. I mean, the environment we're in is incredibly uncertain. We don't know how long it's going to last. But what we do want to make sure is that the companies you're investing in can endure a downturn that could, last 12 to 18, maybe even 24 months, so that you get the benefit in the upturn.
And perhaps as the final point is this table that you put into your clients. Take us through it.
Yeah, this is some work. It wasn't research that we did. It's a very smart crowd called Verdad. We unfortunately don't have enough long-term data in South Africa on the performance of small caps going back to the 60s or so. But they've looked at the subsequent performance in the 24-month period after an initial 20% drop in the S&P 500. So you're not trying to pick or time the bottom. You're just saying when the S&P is sold off 20%, what is the subsequent 24 months return for small caps growth and value and large cap growth and value? And you can see the biggest opportunity is in the small cap value space, with subsequent returns of around 56%, smashing large cap both growth or value, and even small cap growth for that matter. So and we would concur with that. I mean, in the last 3 cycles, as we highlighted in some of the charts in that report that we sent out, it's small cap value where you do tend to see the bigger mispricings. And as the economic recovery broadens, as we become more comfortable with the removal of some of these lockdown restrictions, people's fears abate a little bit, you'll start to see money flowing into, outside of just the top 40 or the safe havens or the rand hedges. And it's in this area that we think you're likely going to see better returns over the next 24 or 36 months.
Well, Ricco, you've given us some great insights on a couple of the small cap companies. I'll certainly be going and looking at CMH and doing some work there. But are there any small caps in your universe that have actually going to benefit from COVID-19? Clearly, if you look in the US, many of the tech companies are doing incredibly well. That's why they're now attracting ever more attention on the profits that are being generated. They're beneficiaries, in fact, of COVID-19. Amazon, Apple, Netflix, Spotify, and so on. Are there any small caps in the South African context that might be beneficiaries that at least we can go into and go and do our homework on?
Yeah, look, it's a great question, Alec. I mean, we don't have the same sort of exposure to tech and innovation, certainly in the listed space in the JSE, as you do overseas. But there are a couple of companies. I mean, there's those resilient businesses, and one of them was mentioned already earlier by Adrian, the likes of an Altron. There's some other businesses like a Cartrack, for example, that largely is unaffected by what's happening as a result of COVID-19. But then there are some smaller sort of unknown companies with some really interesting businesses, the likes of Capital Appreciation, that is exposed to the cloud, and they're one of the leading consultants and providers on Amazon Web Services. They're also a big provider and supplier of new handheld payment devices into a number of the banks. And, the innovation that goes into some of these handheld devices, particularly now where people are not wanting to type in PIN codes and things like that, does position them quite well. So yeah, when you dig deeper, there definitely are a couple of these companies that perhaps could benefit from some of the tailwinds, but not to the same extent, obviously, as a Netflix or as some of the other businesses that you've mentioned, for example.
David Shapiro, do you want to just come in for a last word here? If you've got perhaps another company that you could add to it. Obviously, we are looking offshore for the beneficiaries of this unique circumstance.
The one thing that I wanted to highlight, and I've gone through a lot ups and downs, more so than Ricco, and even more so than Cocky, but Bidvest, Coronation, Investec, Discovery, Capitec, CMH, a great company. All of those were small caps at one stage. If you go back to 87, even in the early 90s, these are all tiny companies. What differentiates them? And the one thing you've got to look at is management. And by management, where I've tracked small caps for 50 years, where small caps go wrong is that there's certain people who are very good at building small businesses, not good at taking small businesses and making them into big businesses. And that's where they fall off the cliff. They're great at the innovation. They're great at that small part, but you need a special kind of person who can grow small caps into big caps. And you've got to identify those kind of people. And that's why I brought up these businesses, etc. Think of Joffy. Think of Coronation Boys and so on, and it just differentiates them. Even Adrian Gore, that just special people who know how to build big businesses on that. So yeah, there are those small caps. They're there. You've just got to go dig them out.
Do any management teams jump out at you, Ricco, that could be the next Joffys, Gore, Swartzbergs, and so on?
Yeah, it's a great question, and one that we've often asked ourselves in our team as well. But it's such a difficult one to answer, looking ahead in time. And in fact, before this call, I just scanned through my list of 90 odd companies to identify, if you had to select a few, who do you think could be the next future big caps? Because as David has mentioned, a Capitec, a Pepcor, Mr. Price, Aspen, all started out their lives as these smaller businesses, and in a relatively short period of time, 15, 20 years, have become hugely successful. Unfortunately, when I look through the universe of 90 companies, you see two things. You see, firstly, those businesses that have been around for a very long time, run by fantastic management teams. They've been through many cycles before. They're robust businesses. They now look quite cheap because they've sold off, but they're unlikely to become the future large caps. And CMH is great a business as it is. I can't see it entering the top 40, but that's okay. I mean, there's still an opportunity to make probably double your money from these levels, at least maybe triple. The one sort of business that perhaps does stand out, and you've got to look for a business that potentially could expand beyond the borders of South Africa, because the reality is, without significant improvement in our growth prospects here, for a small cap to become a large cap just focused entirely on SA is going to be quite difficult. And the one business that does stand out, it's not massive, it's not ridiculously cheap, but is the likes of a Cartrack, for example. And then you could throw Altron in there too. I mean, they've been quite successful so far in the expansion beyond the borders of South Africa. Unfortunately, now they are looking at unbundling their UK assets. So that may, prohibit, from a market cap point of view, them entering the top 40, but they've been incredibly successful offshore.
Ricco Friedrich from Denker Capital, David Shapiro, our man who's always with us on a Monday at Rational Radio, and of course, Stuart Lohman, our general manager here at Biznews, who's going to have the last word. Stu, where can we get the webinar?
Excellent. Thanks all, and thanks again, Alec, as always. Just on the chat at the bottom of the control panel, I put in the Biznews YouTube channel. If you click on there, you can sign up to be a subscriber and you'll get notifications of all our webinars, Alec, which go onto that platform. So not just this one, but share portfolios, midweeks, Thursday noon times, the whole list will go onto that channel. So that's all from my side. Anything from your side, Alec?
Nope, I just know that we're going to be selling Sasol tomorrow. So those of you who are invested in the Biznews share portfolio, do join us again tomorrow. Of course, it is a premium only webinar. We look forward to being in your company then. And that's Stuart and I again for yet another interesting event. I see, Stu, we've had quite a lot of people who came in today, but nobody wanted to share their audio with us. That's okay. We're allowed to be a little shy on these things, but at least now we have the facility. We do know from the tech it works. You can, if you want to in future, pose a question through this webinar. It's only for the premium webinars, the big ones. On a Wednesday, Thursday, Friday, which are open to the whole community. We don't share the microphones there. It could become a little bit crazy. But on these ones for the Biznews Premium subscribers, you have that option next time around. Thanks for being with us. It's our pleasure, as always, to be in your service until tomorrow at noon from me, Alec Hogg. Cheerio.